And we are back. It's Monday, the 23rd of September. We're doing a recap of what happened last week and what we expect for this trading week. And that's for fixed income assets as well as for equity assets. To help us in this conversation is Mr. Reginald Kadzuto. He is the Chief Investment Officer at Amana Capital. Welcome to the show, Reginald.
Thank you, Mita.
Before we look at markets, the MPC is meeting today. What are your expectations with regards to the benchmark rate?
I don't think they'll move it. Going by the trend of their previous MPC releases and the data they look at, most probably you hear them saying the famous statement, inflation is well anchored, anchored in what we don't know, but so most probably they're not going to move the rate from where it is.
Okay.
Yeah, I think on the basis of the data they normally use to make their decision, that data has remained pretty much stable from the last MPC meeting. It will actually be a shock if they move the rate. Will it spare credit? I doubt. Will it change anything in the markets in terms of direction of rates or not? I doubt. So yeah, I guess we'll just allow them to go through the motions, and fulfill the statutory requirements and make the publications, but we shouldn't expect too much from that.
Not too much.
Yeah.
But as a Chief Investment Officer, is there any decision or any communication by the Central Bank of Canada you pay attention to?
To be honest, not really. The CBRA has been, for lack of a better word, an important tool for as long as I've been in the industry.
Okay.
Banks don't listen to it.
Yes.
No one else listens to it. So if the banks that price most of the fixed deposits or the loans don't follow the CBR, so it only got a bit of teeth when it was now used as the reference rate to interest rate capping.
Okay.
But we now know that once interest rate capping came in, the banks just went away.
Yes.
So it's not like we're going to say it will come down, rates will come down in the market, more people will borrow. Because what we need to also look at is, yes, even if rates come down, we are borrowing to do what? Are there investable projects in the economy right now that will give you a good return for you to go for that borrowing? If you look at most companies on the NSE, most of them are cash rich. So there's no need for them to actually go borrow. The economy is not doing well, so guys are not expanding. And if they're not expanding, there's no need for
this kind of capital.
Debt. Exactly.
That's true.
So the CBR, we rarely look at it. What we'll more monitor most is the overnight rate.
Yes, that's a very important
that gauges liquidity in the market.
All right.
And now definitely market results in terms of what is being oversubscribed, what is not being subscribed, just to get a gauge of the sentiment in the market towards where the rates are going to go.
Okay, very interesting. But before we get into the fixed income market, and you've already alluded to the rates and subscription levels, let's just circle back to the NSC. The Finance Committee also last week came out very strongly and said that it opposes any tax amnesty for any new issuances on the Nairobi Securities Exchange. Do you think they have a valid point? Will that deter potential companies from listing on the NSC, or is that neither here or there?
I think it's neither here or there. The NSE has bigger problems. And I think at some point we just need to be honest. Nairobi Stock Exchange should just be called Nairobi 5 Stocks Exchange.
5 Stock Exchange, that's a good one.
Literally, because you have Safaricom, Cooperative, EABL, Equity, KCB,
yes.
And that's the whole market.
The end. That's true.
90% of your market capitalization, that's 90% of your traded volumes and all. So this thing of we have 50 something listed, or whatever number of listed stocks. So I know the MPs might not have thought that way, but looking at it from hindsight is, okay, yes, you give a tax amnesty. There has been tax incentives for listing, and people are still not listing. But then people haven't
taken it up, so it's neither, you're absolutely right.
Exactly, so it's neither here or there.
Okay.
And ideally, they need to get activity moving on the NSC itself,
all right. Okay.
On the other counters, and not just activity on the 5 stocks. They need to get local investors to come, local institutional and local retail investors to come into the Nairobi Stock Exchange, so that we can start seeing more liquidity in maybe in the smaller cap stocks.
Okay.
And the reason why the 5 stocks have more activity is because foreigners will go there.
That's true.
And they will know that they'll be able to come in and come out.
That's
so a foreigner is not going to buy kakuzi or something that...
There's no liquidity, and if you wanted to fill a ticket. But it's interesting. So last week we did see the foreigners dominate, and in revenue, turnover for the week was up 58%. 2.8 billion traded last week compared to the previous week. But it seems like it's dominated by foreigners. Are you local investors in the market, local institutional investors, are they looking at equities, or are they preferring to look at fixed income assets for now?
If you look at asset allocation, even dating back from 2006 up to now,
yes.
If you take the collective investment scheme, at least that's publicly listed data, or from the pension industry, from the Retirement Benefits Authority, you'll realize asset allocation is skewed towards fixed income securities. Most people, or most trustees, or most small investors who invest through these vehicles are extremely risk averse. So as a fund manager, or as a person managing anyone's money, whether it's a pension, or as a collective investment, or as a segregated client, your thoughts will be, yes, I can go into equities now because they're in a good buy position.
They are.
But you're not going to make money the next 1 year, 2 years. You might even drop further down.
Oh, is it? Why do you think so? Because that's contradictory to what we've been hearing. Everybody says buy now because the valuations are cheap, and maybe there could be a correction in 2 to 3 years. But you're saying you can't see any impetus to actually push up stocks, or any triggers.
Why will someone buy a stock? You buy a stock for two things.
Yes.
Capital gains and dividends.
Exactly.
Yeah? Capital gains are driven by people demanding that stock. And why do people demand the stock? Because you believe you're going to get there's sufficient value coming into that business, or there's growth that you're going to see coming into that business.
That's true.
So when you look at that, then you have to go to the macroeconomic level. Because these companies don't operate in a vacuum. They operate in an environment. That environment does not look like it's about to turn around anytime soon.
So you're actually very bearish on equities.
I'm bearish on equities, unless you are taking positions now to start seeing some gains in the next 2-3 years.
Or unless you're doing a dividend yield.
Yeah, if you're doing a dividend yield, which is also a bit, you may get a dividend yield of 9-10%, and the stock goes down 30% in the year.
So then you're still left with...
Yeah, exactly.
Okay, that's
so
true.
if anyone's going to go into NSC right now, you're going in long term.
Yes. What is long term? 5 years, 10 years, 30 years?
Anything above 3 years.
Okay.
You don't, right now, don't go into the NSC thinking after 2-3 months. Yeah, so you won't.
Okay.
And that's the bit of education that needs to go to both the local retail investors, the local pension trustees, and the people around the investment decision making of investments. That do you want a cumulative growth, or do you want to just play safe and earn the mere 6% that you get from Treasury Securities, or 10%? With inflation at 5-6%, again, your real returns are also a bit pathetic. So again, if you look at the Kenyan investment market, it's more of a fixed income driven.
It's purely fixed income.
Exactly.
But does it even make sense? Now, if we come to the fixed income market, 2 issuances for the 15-year, 2 reopens. And they're actually, the coupon was, rather, the market priced it at about 12.67%. So that's 12.67% for 15-year money. Is that a reasonable return? Or is there no reason?
Given where the market is, where the short end of the curve is, if you can get 12.36%,
then you're good.
You're good. You just lock it in.
You lock it in,
and it's pretty much risk-free. So you'd rather just lock it in and move on with life. And that's why maybe you're seeing that there's more subscription on the 364-day paper.
That's at 9.7%.
Yeah, than the 3-month and the 180-day.
Yes.
Because people are just now literally chasing yields. Whatever will give me the highest yield at no risk whatsoever. So you'll find fund managers, or pension fund managers, have close to 60-70%
of their assets
in government securities.
And would that also mean that you're also in the same category? The majority of your assets under management are in fixed income?
Those still have close to 20-25% in equities, which we have kept strategically.
But fixed income is really more becoming.
Yeah, fixed income is a bit more.
All right.
Because after you reap some gain during the year, we're getting towards the end of the year, you want to lock in your return for that year.
Yes.
But keeping a long-term perspective. So that's why we've not completely gone out of equities. But something that might also be informing people to move towards fixed income is the element of systematic risk that is generated every year when the government announces its budget. So every year, you know, there's a change in the fiscal policy, there's a change in taxation. So that uncertainty that comes after every 12 months because of shifting fiscal direction causes systematic risk in the market.
Meaning it affects the entire market.
Yeah, it affects the entire market. So unless you diversify out of the country to get rid of country risk, then you rather take just take government paper so that you are not caught holding a stock that gets an unfavorable fiscal policy stance.
Okay, so I understand where you're coming from, but also like the element that we've brought, every 12 months is always systemic risk once the new budget has been read out. But this time around, we have an additional risk or a non-risk factor. There have been changes at the leadership at Treasury. Is that something that keeps you awake, or are you indifferent to that kind of change at Treasury?
And unfortunately, the appointment at Treasury was more of a political appointment. I don't see anything changing in terms of policy direction or not. It was an appointment just to make sure that you don't get tribal noise. So it was a safe bet.
So it's political.
How do you get someone from Labour and put them in charge of Treasury and try to show us that you have a serious concern about the direction of the economy, the direction of the... So for me, it was more of as long as there's someone there,
there's somebody
let's
there,
move on.
there's somebody there. Yeah. But then, I mean, the same leadership now has come and said that we expect budgetary cuts. The first instance we've seen is a 2% revision to the expenditure for this fiscal year. Do you think that's a trend that's sustainable? Because 2% is really neither here or there. Unless you get us to 10% savings on your expenses, it's immaterial for now. But do you think this could be something that moves from 10 to 5 to 10%? Do you think the new leaders at Treasury are able to deliver this expenditure cuts?
I really doubt. We've heard this story of austerity many times.
Yes.
Then at the end of the year, if you look at absorption of budget, recurrent expenditure absorption is always above 100%.
That's true.
So, until, I think they need to balance the budget.
Okay, that's a long time coming. Reginald, that's a long time coming.
But it's not long time coming. It's sometimes I wonder whether, is it that everyone is just blind or people just turn a blind eye to it? You know what the revenue capacity of the country is. So if let's say it's 1.8 trillion, assuming Kere does a miracle and actually reaches that figure.
But even 1.8 trillion, honestly, is really on the higher side.
Let's give it to them. Let's say Kere can collect 1.8 trillion. You know that's what they'll be able to collect.
Yes.
Why make a budget which is double that?
You're hopeful that they could potentially go over and above that.
Yeah, but then you'd rather start and say, we have 1.8 trillion. We need to make things fit in 1.8 trillion. No,
but okay, Reginald, the reality is we could go back and forth on why they do this, but the question is, it happens. And anyway, my question was circling back to the element of, if you don't think that what they're trying to do is sustainable, then in essence, what the government needs to borrow from the domestic market remains more or less the same amount, which is 350 billion.
Which I think they've already increased a bit.
That's about...
I think they're going to borrow a bit higher.
Okay.
I actually don't think they're doing anything to cut. It's good statements to say.
It's good statements, but in reality,
there's they've delayed to disperse money to the county, so unless they're counting that as a saving, because you don't have to send everything now. You're telling the guy you are 3 months into the year.
No, but it's still an accrued expense either way.
Yeah, but it's not spent.
Okay.
So I don't think they actually have a method and a way of actually knowing how do we cut
back on what we're
expenditure.
Okay.
How do we prioritize what we want to do in terms of development, especially in terms of infrastructure? I think we've done a lot of infrastructure development which is not prioritized to areas where we can start seeing gains for it to be able to finance other infrastructure development. We've gone to the element of, we want a railway, we will build a railway no matter how much it will cost. We want a dam, we want 3 dams no matter how much it will cost.
If we find somebody who can fund it like this, we've had Japan is actually funding a bridge in Mombasa.
Yes.
Just to reduce congestion. That's about 8 billion.
Yeah.
80 billion actually.
And sometimes I think some of these things can be done way cheaper if we really want them to be done cheaper.
Yes.
Sometimes you see a walkway across Thika Road and you're told, this is 3 billion. You're thinking, this is pieces of metal and concrete. Wow. Justify why it has to be 8 billion. 8 billion.
That's a fair point. But then just coming back to the fixed income market, so certainly there will be demand and supply for government paper for the next couple of months. Do you have a sense where investors are more interested in putting their money? Because from last week's performances, the 15-year, the government was looking for 50 billion, it got 32 billion. And you're saying that there's more interest on the one-year paper. So is it that we're getting a shift of interest, people preferring to put money in the short end, but then on the converse, the government is actually demanding for longer dated paper? And how do you balance this?
So I guess people have been putting money in the one-year paper because you'd rather be caught in the 1 year in case interest rate cap goes away and restarts moving. At least you only have a couple of months to like 8-9 months, then you are liquid again.
Okay.
If you put in the 15-year paper and rates do go up, then you're caught in a 15-year paper that is losing value.
Yes.
If the next paper is issued at a higher rate.
You're actually underwater.
So we find it's a bit of a tricky. There's a lot of uncertainty in the element of which direction are rates going to go. Are these guys going to wake up and realize that things are in a mess and they actually just need to increase their CBR rate of theirs to a level where banks will be comfortable to lend? Okay. But at the end of the day, CBK cannot look behind and say blame interest rate cap.
Precisely.
They can put their CBR at 14%.
All right, let me take a pause on that. Whether the question is, are we in a time of uncertainty or a new reality? But the NSE has just closed. Look out for the closing bell. We'll be back shortly.